Hello everyone, my name is Bernie and welcome to my channel Bernie to the Rescue. Today's video is on the lag effect of higher interest rates on the housing market. If you like the content and find it helpful, please like, comment, and subscribe to my channel, or simply share it with a friend or family member whom you love and may find it helpful. Thanks. Now let's get into the video. The lag effect of higher interest rates on the housing market refers to the time delay between when interest rates increase and when the housing market is affected. In general, higher interest rates can cause a slowdown in the housing market as borrowing becomes more expensive and buyers may be less willing or able to purchase homes. However, the lag effect means that the impact of higher interest rates on the housing market may not be immediate. For example, it may take several months or even years for the full impact of a series of interest rate hikes to be felt in the housing market. The exact length of the lag effect can depend on a variety of factors, such as the strength of the overall economy, the availability of credit, and the specific characteristics of the housing market in question. Nonetheless, it is generally accepted that changes in interest rates can have a significant impact on the housing market, even if there is a time delay between the two. Who's more likely to feel the effects of higher interest rates in the housing market? Generally speaking, higher interest rates in the housing market can affect several groups of people, including home buyers, homeowners with adjustable rate mortgages, and investors in the housing market. Home buyers may feel the effects of higher interest rates as borrowing becomes more expensive, making it more difficult to qualify for a mortgage and potentially leading to lower home affordability. As a result, demand for homes may decrease, leading to a slowdown in the housing market and potentially leading to a decrease in home prices. Homeowners with adjustable rate mortgages may also be affected by higher interest rates, as their mortgage payments may increase with rising interest rates. This can lead to financial stress for homeowners who may struggle to make their mortgage payments. Investors in the housing market may also be affected by higher interest rates, as they may see a decrease in demand for real estate and potentially lower returns on their investments. Overall, the effects of higher interest rates on the housing market can be complex and varied, and may impact different groups of people in different ways. Is it best to be a homeowner or a renter during a time of higher interest rates and slower economy? The decision of whether it is better to be a homeowner or a renter during a time of higher interest rates and a slower economy depends on a variety of factors, including personal financial circumstances, housing market conditions, and long-term financial goals. During a time of higher interest rates and a slower economy, it may be more difficult to secure a mortgage, and the cost of borrowing may be higher. As a result, some potential homebuyers may be deterred from purchasing a home and instead opt to rent. On the other hand, for those who already own a home, higher interest rates may lead to higher mortgage payments and potentially decreased home affordability. However, homeowners may also benefit from rising home prices, which can increase the value of their investment. Renters, meanwhile, may benefit from more stable housing costs and the ability to move more easily if job opportunities or other factors change. However, they may also face rising rental prices in a tight rental market and may not have the opportunity to build equity in a property. Overall, whether it is better to be a homeowner or a renter during a time of higher interest rates and a slower economy depends on individual circumstances and financial goals. It may be useful to consider factors such as job stability, long-term housing plans, and overall financial health when making a decision. How does higher interest rates affect the job market? Higher interest rates can have several effects on the job market, as they can impact various aspects of the economy. Here are some ways in which higher interest rates can affect the job market. 1. Reduced business investment. When interest rates are higher, it becomes more expensive for businesses to borrow money, which can reduce investment in new projects and expansion. This reduction in business investment can lead to slower economic growth and potentially lead to job losses. 2. Decreased consumer spending. Higher interest rates can lead to higher borrowing costs for consumers, which can reduce consumer spending on things like homes, cars, and other big-ticket items. This reduction in consumer spending can negatively impact businesses, leading to layoffs and a slowdown in hiring. 3. Shifts in industry growth. Higher interest rates can also lead to a shift in industry growth, as industries that rely heavily on borrowing, such as construction and real estate, may see decreased demand and job losses. Conversely, industries that are less reliant on borrowing, such as healthcare and technology, may see continued growth and job creation. 4. Stronger currency. In some cases, higher interest rates can lead to a stronger currency, which can impact international trade and potentially lead to job losses in industries that rely heavily on exports. Overall, the effects of higher interest rates on the job market can be complex and varied, and may depend on a variety of factors, such as the strength of the overall economy, industry trends, and the specific policies put in place by governments and central banks. How long does it take for higher interest rates to affect the job market? The length of time it takes for higher interest rates to affect the job market can vary depending on a variety of factors. In general, the impact of higher interest rates on the job market may not be immediate and may take several months or even years to fully materialize. For example, if interest rates are increased to combat inflation, it may take some time for the effects of the policy to be felt in the economy. This is because businesses may need time to adjust to the higher borrowing costs, and consumers may need time to adjust their spending habits in response to higher interest rates. Additionally, the impact of higher interest rates on the job market can depend on a variety of other factors, such as the strength of the overall economy, the health of specific industries, and the specific policies put in place by governments and central banks. In general, it is difficult to predict exactly how long it will take for higher interest rates to affect the job market, as this can depend on a variety of factors that are often difficult to predict. However, it is generally accepted that changes in interest rates can have a significant impact on the job market over time. In conclusion, the lag effect of higher interest rates on the housing market can vary depending on a variety of factors, such as the strength of the overall economy and the health of the housing market. Generally speaking, higher interest rates can lead to decreased demand for homes and potentially lower home prices over time. Higher interest rates can impact various groups of people in the housing market, including homebuyers, homeowners with adjustable rate mortgages, and investors. The effects of higher interest rates can be complex and vary, and may depend on individual circumstances and financial goals. Higher interest rates can impact the job market in several ways, such as reduced business investment, decreased consumer spending, shifts in industry growth, and potentially leading to a stronger currency. The impact of higher interest rates on the job market may take several months or even years to fully materialize, and can depend on a variety of factors such as the strength of the overall economy and specific policies put in place by governments and central banks. In general, it's important to keep in mind that the impact of higher interest rates can be complex and multifaceted, and may vary depending on individual circumstances and larger economic trends. By staying informed and taking a careful, long-term approach to financial decision-making, it may be possible to navigate higher interest rates and other economic challenges successfully. Once again, thanks for stopping by my channel. My name is Bernie. If you have any tips that could help someone else during this time, please share in the comments below. Don't forget to like, comment, and subscribe to my channel. Thank you for watching.